Thank you all for attending. For those of you who don't know me, I'm Neal Gandhi. I'm the CEO, co-founder of the Panoply. I'm joined by Oliver Rigby, my co-founder and CFO, and we'll both be taking you through the presentation at various stages today. In terms of what we aim to cover off with you today, we're going to talk about the year ending 31st of March 2020, just gone. We'll talk about the performance there and the second half performance that we had in particular. Along with some acquisitions that really have created a new force in public services digital transformation. We'll talk more about that. We talk about the acquisitions of FutureGov and Amio, which really cemented that position, driving 70% of revenue now coming from UK public services. We'll talk about digital transformation and what that really means. There's a lot of misnomers out there of what digital transformation is. And we'll talk about our commercial financial vision. So we're the Panoply. You'll know us as the digital transformation company in public sector. I think it's worth talking to what digital transformation means. We get a lot of questions about what it is, and I think I'll start with what it isn't. What digital transformation is not is working from home. So there's been a lot of commentary in the press recently that, oh, digital transformation is about to take off because everyone's now working from home. Truly, a bit of access to email, access to systems via a VPN, or even web-based systems in our group is not what we would define as digital transformation. We're talking about the wholesale change of the way public services work, of the way industry works. Dominic Cummings is not particularly popular to quote, I don't think, for many people. But what I will say is that if you read some of his blogs, they're pretty fascinating. And one of his most recent blogs talks about trillion-dollar bills lying on the street, the low-hanging fruit. If you take digital transformation over the last decade, you'll have all experienced automatically or renewing your tax disc on your car, or renewing your passport when it came up for renewal, or going to a photo booth and having that passport photo taken, that automatically updating to your passport renewal application form, and so on and so forth. Seriously, those things are tinkering on the edges compared to what's truly possible. When Dominic Cummings talks about trillion-dollar bills, he's talking about a change in the mindset of people, of decision makers. We're talking about the changes to the science of prediction, the ability to use data to predict outcomes. We're talking about data science, AI, cognitive technologies that truly change the way government can work and government can deliver. And if you take the last decade or so, the austerity decade post 2008, 2009, really what we saw was the public sector taking small percentage points out of cost, really, in terms of what they were doing, getting some sort of minor level efficiencies, but not really. The next decade will be really about those organizations, those leaders being prepared to really think about how they change the game completely. How do they deliver public services? How do you deliver care in the community, both adult services and children's services? How do you deliver a health system that can continue to provide universal health care to an ever increasingly an older population? And all of those macro challenges that exist, you'll see people begin to change how they look at the world. And I think that's the opportunity. The commercial sector example that we cite is Spotify. So if you'll remember, Apple launched the iPod way back when, and iTunes, and all we did was change the way we bought music, but we still bought music. We bought singles for 99p, we bought albums for $7.99 or $8.99 or whatever it was. It's just in the past, we'd go to a shop and get a CD or a record before that. And this time it came down the wires onto our laptop. We still owned the music. The music industry didn't really change as a consequence of that. Artists still made their money from selling music, and the tours were there to support the sales of those CDs. 200 people in Stockholm decided they had a better idea. They decided they were going to change the way that the world consumed music, and they executed. They created Spotify. And today, if you look at the music industry, artists make their money from touring, and the music is effectively given away for free in order to do that. And you've seen a wholesale change in the way that the music industry, lock, stock and barrel, entirely works. That's what we're talking about when we're talking about digital transformation. And that's what the Panoply is about. It's about bringing together real experts in sectors. We're here to challenge the status quo, and in our case, pretty much change the way public services work and how they're delivered over the next decade or so. It's a substantial market opportunity, and we'll talk about that some more in a while. If you take our group, so many of you will know we came together with the first 4 companies in the group: Manifesto, Questers, Not Binary, and Ben Agair. We came together in December 18 at the IPO, at the point of the IPO. At that point, those acquisitions were completed. Since then, we've made another 5 acquisitions and launched a startup, Human Plus, the robotic process automation business. So today, the group comprises 10 companies, but really that's not the way to look at it. We look at the market as a whole. We look at public services. We split public services into local government, central government, health, higher education, housing, not-for-profit. We look at those subsectors as the real opportunity. And for us now, it's about consolidating brands, bringing organizations closer together so that we can go and attack a market. To give you an example, I was on a call with both Future Gov and Amio together this morning. Between the management teams of both of those companies, they pretty much know every chief exec of every local authority of size in the UK today. That presents a huge market opportunity for us if we can bring those organizations much closer together. So, really that's what the group is today, but it's really all about where we take the group moving forward. And the next slide really talks to that. What we want to deliver is a full stack, end-to-end, 21st century value proposition to those public services organizations that are now ready to embrace a completely new future. We start at one end with service design, where we might work with Essex County Council to really look at how does social care get delivered? Is that the most efficient way to do that? And we're not talking about simple changes, or some sort of touching around the edges, 2-3% efficiency gains. We're talking about how do you deliver 40%, 50%, 60% efficiency gains? How do you make sure that a social worker spends 60-80% of their time in front of vulnerable children rather than 60-80% of their time in front of paperwork, in front of administrative tasks? And that's what service design really is all about. It's this changing the way that people work, encompassing design, technology, organization altogether. Organizational design is another level again. So this is where we're working with, in an example of Dorset Council, where in the UK today, there are many subscale local authorities. And there is a government push to really reduce the number of local authorities through bringing some together to create unitary authorities. That structural change that frees up money to enable the changes that are required are really where we're working. And Amio, when we brought Amio into the organization, that's really the level at which they operate at. In order to deliver on digital transformation, you've really got to bring technology, design, and organizational change all together into a single multidisciplinary team. We can no longer work in the same way that we used to work. So we used to work, and the 20th century model is we need a new product, we need to design that product, we need to specify it. It's a process that can take months in the design process alone, and then you go into some sort of build, and then you get into some sort of alpha testing, and then you get into some sort of scaled rollout. It's a process that typically over the years has taken years. One thing this COVID crisis has done has actually shown government that you can turn products out really quickly. And there was a blog by the chief exec of Hackney Council just last week, I think it was. You can't unsee what you've seen. So if you've just seen a new product rollout that creates massive efficiency and you've done that within 3 weeks, then you can't suddenly go back to the old model, the old 20th century model of huge monolithic providers trying to overspec, over-design, get lots of people billed onto the account with scant regard to the outcomes for taxpayers, outcomes for citizens and the population using the systems. So that's why you then bring all the rest of this in, the user research, the user design, front-end design, going all the way through to robotic process automation, where we're working as an example with UCL University to really massively change the efficiency from an HR process perspective and also from a finance perspective. And, really timely, we found a niche in higher education there. We've won another couple of universities recently in robotic process automation, where suddenly they're confronting a potential 60% decline in income starting from September coming. From the new academic year, with next to no international students and with freshers deciding to defer a year because they don't really fancy a socially distanced freshers week. So, with that in mind, the fact that we've made a name for ourselves in delivering on quite sophisticated RPA processes within that sector, that talks about an opportunity that we now have as a consequence of that. And across all of these boxes, what you have today in our group are great case studies, examples of where we've delivered it at scale for organizations. And so by doing so, we've truly created a new alternative. And if you look at organizations today, public sector in particular, They are typically 19th century founded organizations using 20th century technology to try and deliver and solve 21st century problems. And it's just no longer working. And so we present the 21st century option to those buyers. As we say to buyers today, look, choose your favorite big four, which really means about 50 companies, but choose your favorite, put them in the mix, and then put us in the mix and let us compete head to head with them, because we'll show you a completely different way to delivering the outcome that you're truly looking for. So that's really what the group is all about. Our clients reflects this. So 70% public services today. So you'll see a bunch of central government, you'll see health, you'll see local authorities, you'll see higher education and so on. Just to pick on a couple of examples there, NHSX. Last summer, Matthew Hancock created a £250 million fund to really evaluate the use of AI at scale in the NHS. There is an acknowledgement and understanding that the only way you're going to be able to deliver a universal healthcare system for an ever aging population is if you start to get on top of predictives and other areas and more efficient ways of operating. An example would be that we've seen radiologists looking at scans typically get a minute to look at the scan, such as their workload. And as a consequence of that, there's something like a 30% error rate in that work, which obviously has profound consequences for people's health outcomes. So what the NHS set up to do was to create a process to evaluate AI technologies, to experiment with them, and then to work out which ones they would roll out at scale. We won the bid back in January. We weren't able to announce it at the time, to work with NHSX to come up with the process with how they would evaluate those technologies, reflecting the fact that we had both sector expertise and technology and AI expertise. It was a bid that involved 4 parts of our group. It involved the robotic process automation piece, it involved the service design piece, it involved the cloud migration piece, and it involved the conversational AI part of our business, all coming together to kind of win that bid. It's a great example. We talk about 70% being public sector. Obviously, that means 30% is commercial. Worth noting, I think, at this point, that in the commercial sector, so 30% of our revenue, 2/3 of that is recurring. So the best part of £9 million in this current financial year is recurring, almost all in the commercial sector, which means the remaining 10% is project by project. So it's pretty robust. If you look at the spread of clients and you look at the Dow Jones and News International and Cargill as organizations that we're working with, across the board, I think as we go into the next couple of years, which I think are going to be pretty rough overall for many businesses rather, we think we're in great shape because we're both public sector, and where we're in commercial sector, we're in very large organizations. So we don't think we're going to suffer particularly from things like bad debt or anything like that, and our debtor days kind of remains strong. So in terms of FY20, so we acquired FutureGov back in June last year, June 19, and Amio we completed in March of this year. And that took us to over 400 people across 10 businesses. And in terms of financial growth, so we went from 15.6 million revenue to 22.1 million revenue, to the number that's in the market right now from Progressive is 30.2 million revenue. We put out a trading update back in April, 24th of April, essentially saying that we were in line with market expectations, both on revenue and on EBITDA. Also worth noting, of course, that in our business, because it's very heavily weighted towards public services, H2 is typically much stronger than half one. But that being said, on a pro forma basis with Amio included, H2 would have been 21.8 million of revenue. So we're showing robust growth, and we'll come and talk about the coming quarter, the quarter that we're in, the latest trading update that we put out at the end of May in a little while. In terms of financial stability, we find ourselves in a great position. As some of you will have known, when we did our trading updates the end of April, we announced that as of March, 31st of March, we had £4.5 million cash against a £5 million revolving credit facility. On the 24th of April, that was actually sitting at 6.2 million of cash, so 1.2 million net cash. So in a great position there as well. And the number, again, the progressive number that's in the market is for the year to have been 3.2 million adjusted EBITDA. And as I say, we've announced already that we're in line on that as well. What we have seen in the year are those collaborative successes. So NHSX, I've talked about. Food Standards Agency, another client where 4 parts of our business are actively involved in that client organization at the moment. Camden Council was much more of a COVID related project that came up, which I'll come and talk a bit more about, but it involved 3 different parts of our organization coming together very, very quickly in an emergency response type project. So really good. Now, we're not simply here to maximize revenue, fee income, to hell with the consequences almost. We want to be a purposeful company in everything we do in terms of the impact that we make, the projects that we deliver on, and so on and so forth. And so you'll see that the Future Leaders Program is something that we invested in. And we supported 5 young entrepreneurs, and we gave back 1,000 hours during the year as well. In terms of COVID response, some of you will have seen some of the work that we've done there. I mean, the one thing I would say is that I would say we were ahead of the game. So we began to recognize early February that this was going to be a problem. We could see it coming. We instigated a number of things. So by early March, we were already working from anywhere. Very easy for us from a systems perspective. We're cloud native. From a process perspective, some work had to be done around delivering workshops and so on and so forth. So we instigated that pretty early on. Some leading indicators that we measure the business on, that we measure on a monthly basis, we brought those forward to being measured on a weekly basis. It gave us a real-time view of what was going on, which we felt we needed. And it's been an incredibly valuable thing for us to do. We didn't furlough any of our staff in the UK. In terms of projects, we worked on ventilator manufacturer dashboards to bring various manufacturers together to manufacture ventilators. We worked on PPE dashboards for North East London NHS Trust. We worked on Camden. Camden was interesting. They suddenly found themselves with however many vulnerable or shielded people within their community that they suddenly had to provide support for. And we built a system from scratch within days and weeks to roll that out. And the NHS, we switched from the AI work that we were doing to providing digital remote care solutions and automation to rapidly improve some efficiencies. And the things like PPE dashboards as an example, where prior to that, it was all being done manually, it was all spreadsheets. And clearly that had to be done substantially more efficiently. In terms of financial position, as of the latest trading update that we put out, talked about cash. When we saw the COVID thing coming, Ollie contacted the bank and said, what are you thinking on this? And actually, it's certainly in the parts of the bank that we deal with, we were the first to talk to them. And I think they've been pretty impressed with the way that we've been running things, as they immediately held out the opportunity to take on a £1.5 million overdraft facility, which clearly we haven't touched, don't need to. But at the time when we took it, we just thought we need that extra safety blanket just in case we need to dip into it. But actually, as it turns out, we didn't need to. Second half revenues for last year increased to 18 million from 13 the year before. We came into this financial year with a backlog of £15 million. And then the first 8 weeks of the year, since 1st of April, we signed a further £9.5 million, of which $5.2 million, so £4.25 million, was with a very large global philanthropic organization. It's a significant project to work with EU cities on digital transformation over the coming 14 months or so. So it's been a fantastic start to the new financial year. We couldn't have hoped for any better. Clearly, it remains a dreadful time. It has been personally for me as well, for other reasons, and a dreadful time for many, many, many people. But somehow through all of that, we've, I think because of our value proposition, because of who we are, because of our values, I think we've continued to trade exceptionally well through that. I will state, and for the record, that it's still very difficult to predict the future. We live in a very uncertain world, made almost more and more uncertain every day with everything that's going on. And so, difficult to predict the future, but certainly as it stands today, the number that's in the market for this year, I think is 37 million with Progressive. 66% of that is actually already booked with 10 months to go. Over to Ollie.
Brilliant. Thanks, Neil. Hi, everyone. How are you doing? Wanted to just focus on a little bit is to talk about the future and our aspirations as a group, as Neil talked about. I want to talk about our ambitions, and these are not a forecast. So we have an ambition and a business plan that we wrote about 6 months ago to achieve run rate revenue of £100 million by the 31st of March 2023. So that is just under 3 years from now. I think we believe it's realistic. 18 months ago, we effectively started with nothing, acquired 4 companies, and now, very broadly, we're at a circa run rate £40 million business in 18 months. So that's our ambition, to get to 100 million. And I just to sort of talk you through how we intend to get there. So the first thing is that we are looking to our existing businesses to grow organically. We're in a great market where there is underlying growth, and they're well positioned, have great customer relationships, and a great opportunity to expand. And so we're targeting circa 10 to 15% organic growth from the businesses we own today and the businesses that we will look to acquire. Added to that, we want to add about £40 million worth of revenue through further acquisitions. Actually, when we wrote this plan, as I said, 6 months ago, it was 40 million. We've subsequently completed the acquisition of Amio, which was circa 7 million run rate business. So that sort of brings that number down to sort of between 30 and 35 of additional revenue that we're looking to add over the course of the next 3 years. I think it's worth noting that we expect to continue to be cash generative. We typically only buy cash generative businesses, and they will typically achieve circa sort of between 15 and 20% operating margin. So we expect circa 70% of that profit to translate into cash. So we expect to be significantly cash generative throughout the future periods. And the intention is to use that cash really for two things. Number one is to pay a progressive dividend. I think in different circumstances this year, we would have been looking to initiate our first dividend. I think given everything that's going on, we've decided against that in connection with the results of 31 March 2020. But I think absolutely the aspiration to start paying one from next year. And what we're looking to do is to pay a dividend at circa 15 to 20% of net income to shareholders. I think the additional cash that we generate on top of that from profits, we're looking to reinvest back into those acquisitions. And I think it's worth noting that we are in a very good place to fund further acquisitions. Typically, the acquisitions we make are predominantly share-based with an element of cash. Up to circa sort of 30% cash, 70% shares is a typical deal structure for us now going forward. And we're well positioned with we're in a net cash position today. The bank has extended an overdraft facility to us that they're already talking to us about extending into a much bigger RCF facility should we need it for future acquisitions. So we're talking to them about that. I think the key point is that we don't want to over leverage ourselves, and we'll look to cap leverage at about 1.5 times EBITDA. That's the route. So organic acquisitive growth to take us to 100 million of revenue by FY 2020, and we should expect that to deliver a net profit of circa between sort of 10 and 14. We're currently trading at about 11% net profit margin at the moment, and that's on the basis of a relatively significant central function that we have invested in to help drive the growth and drive acquisitions and process, etc., as well as all the associated AIM and listed PLC costs, and that runs at circa £1.75 million at the moment. We don't anticipate that growing significantly as we add further acquisitions, and so we would expect our margins to improve as we grow. So if we just go dive into that in a little bit more detail, so how do we see that organic growth being delivered? So I think number one, first point to note is, as we talked about, we're in a growing marketplace. The market for digital transformation is ever growing, and Neal will touch on some figures on that in a minute, I think. We're well positioned. We've got great businesses within specific sectors or within specific capabilities. And I think that takes us back to the original vision for the Panoply going back sort of 2 or 3 years ago. And that was the idea of bringing together best of breed companies that can provide focused services in order to allow them to deliver bigger transformational projects for clients than those businesses could have delivered on their own. And that continues to be our strategy by sort of consolidating some of our brands around vertical markets. So we'll see a bit more joined up go-to-market strategies from within the existing group to drive further organic growth. And we're already starting to see that in terms of multidisciplinary wins, as Neal alluded to earlier, around NHSX, Camden Council and Food Standards Agency, which is another one where we've been working with 3 or 4 of the businesses within the group have been delivering on that project, or were in the back end of last year. I think the other area of where we're looking to invest and generate organic growth is through further investment into businesses we have within the group and or new startups. So worth talking about Human Plus, our robotic process automation business. We looked at acquiring an RPA business about 1.5 years ago, and there was a business that was sold in the market at the time, went for a very high revenue multiple, and was not profitable at the time, and we felt that probably wasn't a market we could buy or we wanted to buy, unlikely to be earnings enhancing in the short term. And so we decided to set out to create our own business there with Human Plus, taking some existing members of the team from within one of our other businesses to help drive that business forward. I think it's worth noting that that was pretty much a startup, and will generate circa £1 million worth of revenue in its first year, which is really exciting, and is a very strong partner with Blue Prism, particularly in the public sector, and is also starting to work a bit with Microsoft and the opportunities that could come out there, who are investing heavily into that space at the moment. Also, we've got Green Shoot Labs, which is a business that we did acquire, but effectively was a startup. We paid no consideration for it at acquisition. Came into the group with very limited revenue. Again, we've seen great opportunities with that this year and continuing into 21. Working with some really interesting clients and the opportunity to grow that. I think there's also some underlying technology in that business that we think is a great opportunity itself, and we're exploring how we might take that further as well. I think those two businesses combined generated circa, it's going to be about 1.5 million of revenue for the full year. And that's based, for H1 was down at 0.4, so 0.4 versus £1 million swing in half one to half two just shows the growth opportunity for those businesses. So organic growth based on bringing businesses closer aligned, as well as sort of making some long-term investments into future services along the way. Just coming back to sort of the other pillar around growth is around acquisition. The first thing to note is that we've made 9 acquisitions effectively in 18 months. All of those acquisitions have been originated by ourselves. So we've got our own internal M&A team. Originally that was Neal and I, and we've sort of expanded that a little bit to bring in some other people to do that. So we're looking for our own opportunities, and we are super targeted in terms of what we're looking for. So we are either looking for specific vertical market offering, or presence, or one that adds to our services that we don't currently have. So current focus at the moment might be around sort of Microsoft Stack or CRM, or anything that might bolster our capabilities within the public or commercial sectors. I think the key point to note is that as I mentioned earlier, acquisitions are typically funded through cash and equity, typically on a 30-70% split. Will continue along those lines for the foreseeable future. The key point there is that there's a significant amount of equity that ties in the founders of businesses we acquire to the long-term prospects of the group. And I think that's really important in terms of the businesses we attract. Most businesses we attract and founders that we attract that look to sell to the Panoply are those that see a bigger opportunity ahead of them by being part of a group, and are excited about the future being part of a group will bring. And therefore they don't necessarily see a sale to the Panoply as an exit, but more an opportunity to invest their business and to create something even greater for the longer term. We're seen as a great home for the people. We're very purpose-led. We have very impactful projects that we deliver, and all of those things tend to attract businesses to us that perhaps other traditional buyers may struggle to bring in. I think the final point to note here is that, as I mentioned before, we've got great firepower to pursue further acquisitions as we stand today. So back over to Neal just to summarise everything we've talked about.
Sure, thanks, Ollie. Yeah, just to summarise, I guess, on those points. So why invest in the Panoply? Well, I think fundamentally we're a strong financial play. We are profitable, we're cash generative. In effect, you're exposed to some of those cutting edge technologies. Conversational AI is huge. It's not yet huge, but it's going to be huge. We will finally move away from the keyboard as primary interface, and that means that enterprise scale, being able to deal with natural language within regulatory environments in particular is going to be particularly challenging, and we think we're in a great position to help with that, and there's more to come on that front. But we're profitable, we're cash generative, and exposed to some really interesting technology plays as well. The digital transformation market in UK public sector alone is a total addressable market of £20 billion by 2025. It is an enormous market that we're playing in, and we're increasingly positioning ourselves as the old guard versus us. Choose any of your old guard, they can all be part of your pitch, and they'll all be saying roughly the same stuff. And then we come along and say something radically different, and I think that positions us incredibly well. Outside of public sector, the whole global digital transformation market is expected to be $600 billion US dollars by 2023. I talked about this already. We're a unique 21st century proposition for clients. They're beginning to realize buyers are getting smarter. They can see through the stuff that the very large organizations, the monolithic providers, have been saying for an awfully long time. I mean, we have lived through, all of us have, the National Programme for IT for the NHS to try and get patient records up and running. £20 billion of taxpayer money wasted. Collectively, we are no longer prepared to tolerate such outcomes for both our users and also for taxpayers. And I think we're well positioned to take advantage of that. We continue to invest in growth. Yes, it's an uncertain world, but there are some things, even through that uncertainty, that are given as far as we're concerned, they're given. We will move to conversational AI. That's an inevitable. We will move towards much more automation in the form of robotic process automation to really solve the problems of legacy technology that most organizations are kind of dealing with. We've got this laser focused acquisition strategy. We go for the companies that we want. We pick them specifically. We don't work with brokers. Typically, we typically find the organizations that we want. We originate from within because we identify those areas where we really want to strengthen our capability. With all of that, the other thing is our extended management teams, the entrepreneurs that run these businesses, are big shareholders in the group. If you look through the share register of shareholders today, you will see significant shareholders are people like James Herbert or Sasha Rook or Kira McCooey, or you'll see a number of people, a really wide spread of people across the group who are significant shareholders. This is their primary source of wealth. They don't have any other sources of wealth. Their only realization of wealth from this group will come when we deliver on that organic growth story. We deliver on the acquisitive growth story. We increase liquidity. We get to the point where they can begin to realize some of that over a period of the years to come. I guess the big thing is purpose. And we're absolutely committed to being a purposeful company that delivers high impact work because we see it as symbiotic with profitability. The more impact we deliver, the more successful we are for clients, the more work we win, the more profitable we become, and it just becomes a circle. So that, I think, is it from me.
We already have one question from John Cockrell, who asks, if you create a transformational solution for University A or local authority B, there's clearly a rollout potential. What are the commercials on the IP?
As a pure services company, the IP, it's an interesting one because IP today is not really in the code. We live in a world of open source and GitHub, and it's not particularly in the code, it's in the know-how. And the know-how is with our people. We know how to deliver on outcomes. I mean, if you took children's services in any local authority, it would be unusual for FutureGov not to at least be on every single shortlist of every opportunity in children's services. Because all of that experience and knowledge gets fed into the next project. Code itself, sometimes the client owns it and sometimes we own it, but it's not actually the key factor for driving margin, particularly as we can move towards more outcomes-based work, where clients value outcome, and then increasingly buyers are aware of that. They're not just buying a day rate, they don't just buy the cheapest day rate possible. They know that they're looking at value for money, and they know that when they work with us, they'll get the outcome they're looking for.
And we'll move over to Freddie Ahad, who has a question.
Hi, Neal. Thanks very much for a really interesting presentation. You've spoken quite a lot about robotic process automation and conversational AI. How do we sit in the overall marketplace for these things?
So we're a services company. We partner typically with the big software organizations. So we partner with Blue Prism to date. In RPA, you will see us partner more closely with Microsoft. Microsoft made an acquisition a couple of weeks ago that showed very clearly their intent in the whole automation space. And so we will partner with them. We're well on the way to becoming silver partner, and then we'll make it to gold pretty quickly after that, I imagine. That's how we sit with those plays. Conversational AI is a bit different. So the biggest player is Google with a product called Dialogflow. We partner with Dialogflow. But we do actually have some IP there, and Ollie talked to it a little earlier, something called Open Dialogue, which is a missing piece right now. around how an enterprise in a regulated environment actually deals with that. So one of the things you have to do is, if you've automated through some sort of chat bot or voice interface a conversation of a customer, say, into a bank about a mortgage. Typically what Dialogflow and Amazon Lex and Microsoft's offering, what they all are black boxes that kind of make decisions on the interpretation of what was said and therefore what the answer will be. In a regulated environment, you can't just rely on the black box. You then have to have some sort of audit trail of what decision was made when and what was said back to the customer. And that's where Open Dialogue sits. Open Dialogue, I think, as a consequence of that, has found itself in a unique position of a partnership situation with Google Dialogflow there. And we're very excited. I mean, it's early days, but we're very excited about where that could go.
I see. And a final quick follow-on from that. In the cases where we are using Blue Prism software for a client, does that make us a reseller for Blue Prism? And if so, can you give us an idea of what the business model is, what kind of level of commissions we might be getting here?
Sure. So we don't focus on that part. We don't, we're almost reseller by default. We focus on the services revenue first and foremost, and it's good high margin services revenue. The resell bit, where we just end up having to resell some licenses, and it's a tiny fraction of our revenues. We make 20% at the moment.
George O'Connor asks, how is the pricing environment? Are customers looking to negotiate down on price given the COVID-19 backdrop?
There's a number of things that we're seeing. So first is in local authority levels, a great deal of confusion as to what central government actually committed to paying during crisis versus what they're now actually stepping forward to giving in terms of giving cash to local authorities. So that's going to come out in the wash at some point, I guess. And so, there will be some sort of pressures there. We are also seeing that some of the monolithic providers out there are trying, obviously they're taking a hit in some other parts of their business. Our commercial exposure is, 2/3 of our commercial business, 20% of overall is recurring with very strong customers anyway. So we don't take anything like the same kind of hit as some of the other organizations in terms of utilization and so on. So I think they're going to be trying to buy some business. However, there is an increasingly aware chief digital officer that knows the tricks. They understand that just chucking in an inexperienced person on a day rate isn't necessarily going to deliver the outcome. And at the moment, there's much more focus. There is an increasing focus on outcomes. There will always be some buyers that will revert to type and will go back to, Big Four-esque type providers and beat them down on price and do that whole procurement piece. But there is growing awareness in procurement in public sector that it's not always about that. It's not just about that. It's also about, are we actually going to get the project we're looking for? If you're a government department, we worked with a government department a year ago, DVLA. They're spending the best part of £80 million on maintaining a couple of mainframes. At some point, you've got to have a value conversation that says you've really got to move away from that onto modern cloud-based platforms, and it's and the success of that being achieved is where your return is actually going to come.
And we have a question from Bob Lau.
Hi, yes, I just want to know, your focus is on more radical transformations of public sector, and I can see how that niche is extremely attractive. Just want to know how you get the public sector entities to accept that change. Many of these entities have been sort of needing that change for some time, and just want to see how you get them across the line. And the second question is about your acquisition strategy. You've done obviously a lot of acquisitions over the last 18 months. Just want to know what you sort of think how your acquisition strategy might have changed from what you've learned over that time.
Sure. So let me talk to the first question around the boldness of approach. The way that we attract attention there is by being bold in our responses. In public sector framework, procurement frameworks. We had a very large client that we won a couple of years ago, DVLA. We were one of 10 companies that had responded. 9 companies went in with what we would regard as a very traditional approach. And we went in with quite a radical approach. And we went straight from that initial list of 10 straight to procurement without the shortlist process that normally would happen. Because funny enough, they had had 2 or 3 previous failed attempts, and doing more of the same definition of stupidity, right? Is doing the same thing over and over again and expecting a different result. So I think it's our boldness of approach, and sometimes we will get buyers that will go for it and we'll understand that, and sometimes we won't. And we're getting increasingly good at working out which ones ahead of time before spending too much time on a bid, and working out which ones are likely to be receptive to that kind of message. And as time goes on, that just changes. I talked about the chief exec of Hackney Council talking on their own blog around not being able to unsee what they've seen. When they saw systems being conceived on Thursday, rolled out by the following Friday, albeit in an emergency situation with our people working 15, 16 hours a day, 7 days a week. When they see that, there's no way that they're going to sign up to a program of work that says you spend 3 months and you get a PowerPoint deck. You wouldn't do that again, would you, when you know that you can prototype really quickly and put something in front of users and work out if it's going to work or not? So I think that boldness of approach, I think, will continue to be a defining aspect of our brands, and will be how we continue to win disproportionate amounts of business. And then to talk
just one other point on that, Neil. I guess that you sort of touched on earlier was the fact that we expect budgets to change. We expect probably the pain to be felt by public services as a result of COVID-19. We don't think that people want to go back to austerity, but there's definitely going to be more of a requirement for fundamental change and big changes that have big impact on reducing costs of delivery of services. And I think that plays absolutely to our advantage, again, of being bold and coming up with bold solutions rather than the tinkering around the edges. It's
a really good point. I mean, there's a project that we did with the London Tri-Borough, which was it's now Byborough, but anyway, it was Hammersmith and Fulham, Kensington, Chelsea, and Westminster. FutureGov did it, and they won Computing's IT Project of the Year, and it was around children's social services. That project delivered a 40 to 50% productivity improvement for social workers in terms of face time with vulnerable children. These are the kinds of approaches when budgets start to tighten up, as they inevitably will. That's the kind of returns that people are going to have to get. They're not the last decade was about taking 3% out of this and 2% out of that and 5% out of the other. We've got to approach it completely differently. And the Spotify thing I started with is that's where the opportunity really lies, is looking at things completely differently. Your next question was about acquisitions. What have we learned? We are getting better and better, actually, at making sure we fully understand where those acquisitions are going to fit into our overall picture, from not just from a capability perspective, but also from a personality perspective as well. And really, before acquisition, ending up with a common vision of where we want to take their company, along with some of the others within the group, to create something even more powerful than the one that's out there. An example would be the FutureGov and Amio deal. So Amio we completed in March. Between FutureGov and Amio, they know pretty much every council chief exec of any scale. Between the two of them, they actually personally know every chief exec. And so we've been working really closely to that, right? How do we really bring this together to create a proposition that we can go out to together with to go capture a decent slice of the market?
Just when you're looking at pitching on projects, obviously the companies that you acquire have kept their brands. To what extent does this, the Panoply Center get involved, and to what extent is it led by the various brands that you've bought?
That's a really good question. Talk straight to the heart of some of our operational things that we've been working on. So historically being, we've only been around 18 months. So historically we have the lead brand will take the lead on it. And so the NHS X deal was fronted by FutureGov, actually fronted by Human Plus, actually. And the others came in behind effectively. What you will see us begin to do over in the coming weeks and months is a gradual, very careful brand consolidation exercise where we end up with fewer brands with very clear messaging, so that clients get a more integrated feel, a simpler buying situation. And that's something that we're actively working on as we speak.
And we have a question from John Cockrell, who asks, software projects have notoriously high fail rates. Have you got blemishes on your record from which you've learnt?
That's interesting. So it is right? So the reason that software projects have historically failed is because they've typically followed what's called a waterfall process, which is specify it to the nth degree of detail over many months or longer, and then get on and code and eventually start to show something to a customer after a year or two. And funny enough, what the customer eventually sees is nothing like what they had in their mind. And you've all seen that cartoon, that very famous cartoon with the swing. So, that's the history of software. And in an agile world, you work iteratively with the client in near real time. So what you do is you start to work up what the requirement is, what are the goals, and then you start prototyping really quickly. So you're showing within weeks, you're showing something, and you're getting that feedback pretty quickly as to whether no, that wasn't what I had in my mind at all, or that, but with these tweaks, and that sort of constant iteration. So you don't tend to have the same sort of failure in a truly agile world. You don't tend to have the same kind of failure that you would have in an old waterfall type world. Unfortunately, the large monolithic providers tend to view agile as a get out of jail free card, because they're not on the hook for any, in theory, they just transplant that as time and materials contract. So here's the heads, here are the people, they've got the capability, but they sort of push responsibility for product delivery onto the client, and just and so never ever take on responsibility. We take a different approach where we work very closely with them on outcomes and what outcomes they're looking for. So it's a very different approach. So that's a really long way of answering the question. I mean, I can't point to, I'm not saying that we wouldn't have had any at all, but I can't point at the moment to any examples of failures, because generally it just works very differently to that.
And the penultimate question, Jeff Hargreaves asks, can you clarify the key tranches of share issuance that are scheduled due to earn-out terms and options issuance?
So typically, it's just worth talking a little bit about the way we buy businesses. So we typically buy businesses based on an earn-out multiple and a formulaic approach to acquisition, which sees businesses acquired for a set multiple of EBITDA at the point they come into the business. So typically that multiple is anywhere between 4.5 and 7 times EBITDA. So if we had a business that was doing £500,000 worth of EBITDA, we'd typically pay £3 million for that business 6 times 500,000. And what we then do is there's typically a 2-year earn-out within the acquisition agreement, which means that we revalue the business based on its results for the year after acquisition and the year after that. So if a business grows from 500 EBITDA to 700 EBITDA, we effectively revalue that business at that point, and 6 times 700,000 would be 4.2 million. So the delta between what we paid originally and the new valuation is 1.2 million, and that's typically paid in additional consideration in shares. And then we revalue it again the year after. So if that profit goes from 700 to 900, again, there's a 200k difference in profit times 6, equates to a further issue of 1.2 million of shares. So what we do is we pay for growth over a 2-year period beyond acquisition date. Set against that, we have a clawback mechanism. That means if a business goes the other way around, we are able to claw back shares against that valuation. So if a business came in at 500 and then dropped down to 300k EBITDA in the year after acquisition, we would claw back 1.2 million pounds worth of shares. So protecting investors in the event that we make a mistake. I think the interesting thing about that acquisition formula is that it means we bring in businesses that are confident about their future, and it's a fantastic piece of due diligence for businesses that aren't confident about their future or are looking just to exit the business as quickly as possible because they don't believe in the long-term prospects of their business. Currently we have a relatively significant amount of additional consideration to pay out in connection with sort of 5 or 6 of the first acquisitions that we made, and we anticipate there being circa 21 million or so of additional shares to be issued following publication of the results in July. Now those shares are payable, a relatively significant, I think roughly about 40 to 50% of those shares will be payable on publication of the results, and the remainder will then be spread over the next 12 to 24 months, depending on when that SPA was signed. So the additional shares will be paid over that period. I think it's worth noting that in all of the SPAs, we have a clause within the SPA that means that the shares are issued at the higher of the price that we did the deal at, and or the price on the day of issue of shares. So currently, the floors in those issues of shares are between 74 and I think 92.5p. Clearly, if we were trading at £1.50 versus 74p, then the number of shares to be issued would halve. So that was based on our best estimate of that. So that those shares, I think we've got roughly 4.5 million options outstanding that have vesting criteria over the next between the next 1 and 5 years. But are all based around performance. So some are linked to share price and some are linked to the underlying performance of the individual businesses we acquire, generating above 10% per annum growth during that period.
So that's the end of the questions. Neal, do you have any closing remarks?
Just thank you all so very much for listening in. The thing that guides us is both the purpose and that financial commercial vision that Ollie talked to earlier, and we are gunning for that by March 23.